All right.
Wow.
The S&P currently up 10% over the past year. Are we in a bull market? And how should you be investing right now? So joining us is Dan Genter, president of RNC Genter Capital Management. Keith Springer, president of Springer Financial Advisors. Harry Rady, CEO and portfolio manager, Rady Asset Management. Dan Genter, I begin with you. Your take on Laszlo Barini. He said 2,100 on the S&P, a long stone's throw. Do you agree with him?
Well, I think we'll certainly see it, Larry, at some point in time. I think it's a matter of when. I think when you start to look at a little more reasonable time period, we're probably on a relative basis equally as bullish, feeling that we'll see 1,400 by the end of the year. I mean, and that's not to whistle through the graveyard and basically say that the things that are happening on the global scene are not significant, but I think we probably took $2 out of S&P earnings, which is going to keep us at 96 for this year. You're trading at a 13.5 PE. Earnings are going to be up 8% with solid margins, good cash flow. And at the valuation where we are, I think people are looking at this realistically, that even if we took a quarter or 0.5% off of GDP, we still have solid growth for 2011, 2012. So I think we'll see 1,400 and keep moving from there.
Keith, Laszlo Barini isn't alone. I want to play for you a soundbite that Barry Sternlicht said earlier, also on Squawk today. Here's what he had to say about equities.
The equity market as a market looks cheapest among probably most of the asset classes right now. The equity markets on a multiple basis with the growth opportunities for companies in Asia and Latin America, they probably look cheapest as a major asset class. Certainly it's not the bond market.
Keith, what do you think? Do you agree with that?
Well, in some respects I do. The equity market looks very cheap, and I think the market can go certainly a long way up. I'm looking for 1,500, 1,550 in really just a few months. I think there's a big catch-up rally for the individual investor. I think most of the individual investors, the average person, is really on the sidelines. They're in cash, they're in bond funds, and they're not in bond funds because they think it's a long-term investment. They're there because they've been afraid the last 2 and 3 years, and they're looking for a reason to come back in. And let's face it, the market moves on earnings. Earnings have been really strong. They're going to continue to be strong. And at some point, there's going to be a panic buy on the individual investor that's really going to push this market and drive it higher in the short term. I don't know about 2,100, in 6 months or a year, but I can see it happening down the road. But I really think the next few months are going to be very strong once we get out of this little correction.
Harry Rady, let me come to you. What about some other issues? A falling dollar, a rising gasoline price, and the effect on consumers, for example?
Yeah, I'm not as bullish as the other guests. I'm certainly bullish, but given the uncertainty in the Middle East, Japan, we think that investors are underestimating the effect it's going to have on Q1 earnings. Our channel checks have shown us that the consumer is pausing, that spending has slowed down in the last couple of weeks. So we would be more cautious. And as a long-short manager, given the uncertainty and volatility, that creates opportunity for managers like us, given that we're able to protect our portfolio, and which gives us the confidence to buy when markets are falling.
Dan, is there a disconnect around the world? I mean, you guys all sound so bullish, except for maybe Harry, but at the same time, we're looking at events going on in Portugal. The government may collapse. We're looking at events going on in Japan. We're looking at the Middle East. Are we an island? Does it not matter?
Well, I think what's going to happen with the U.S. market, Melissa, is that we are a little bit of an island from the standpoint of what's going to drive it, which is going to be the earnings mainly of U.S. companies, and certainly our import-export picture is going to drive those earnings also. But I think people are looking at it from the standpoint that the resiliency of this market has been tremendous. I mean, the fact that we only went down 6.5% from high to low, considering what was happening worldwide, frankly, was no more than probably would have happened eventually without those events. So I think, once again, people are going to look at the earnings momentum here, which even if we shaved a little off, it's still going to be substantial. And this market wants to trade at about a 14 PE. We've been there plus or minus for the last 2 years, and we're 13.5 now. Even though the earnings may slow a little bit, it's still going to be close to double-digit, and that's going to drive stocks further from here domestically.
Well, Keith, look, everybody's so Pollyannish. I guess maybe not Harry, but Keith, I want to ask you about earnings and earnings momentum. What about raw material prices and energy prices? The input costs to corporations are rising much faster than the consumer prices they're getting at retail, even though the CPI is up. Is that not a squeeze? Is that not something an investor should be concerned about?
It actually is, Larry. It certainly is, and it's going to happen down the road. We've got to remember that's going to be 6 to 12 months away before it's actually felt and can be possibly passed on to the average person in prices. What we need to look at is the market. Earnings for the next 1 to 2 quarters are going to be strong, and the market is driven by earnings. Also QE2, I expect a QE3 probably after the Fed tries it.
QE3, you expect a QE3? You guys
I do,
are also,
with a different name, Larry. I don't think they can come back with it.
You guys are all telling me how strong the economy is. Why would the Fed do QE3?
I think they're going to need it. I think they're going to probably take it off the table for a month or so like they did last time. Find out they need it. It may not be as strong as the last one. It may not be called QE3, but they're going to need it. And what's so important for investors, Larry, is they've got to have a protection on their portfolio. They've got to participate. They've got to go for dividends. They've got to look for ways to participate on the upside, but protecting the downside. And that's what we do for our clients.
We got to leave it there. Thanks so much, guys.